So, earnings calls are a lot like makeup contouring.
Oh, absolutely.
Right. Like a management team uses their prepared remarks, kind of like a really good highlighter. They deliberately try to catch the light on, all the most flattering angles of the business.
Right. They want you looking at the shiny stuff.
Exactly. They illuminate the record sales, the flashy new brand launches, the rosy projections, but then they also use shadows, like bronzer.
To hide the bad stuff.
Yeah, to try and recede or minimize the blemishes. They want to hide the rising operational costs or softening foot traffic or those nagging macroeconomic headwinds that might be, eating away at their foundation.
Yeah, the corporate PR spin.
Right. So our job today for you, the listener, is to basically hand you the makeup wipe.
I love that. Handing over the makeup wipe.
We are going to wipe all of that corporate contouring away and just look at the barefaced data. No filters, no soft lighting.
That is honestly the perfect framework for what we are doing today. Because when a company is standing at a podium, every single syllable is scrubbed by legal teams, by investor relations.
Oh, for sure.
And our mission here is to look past that script and see the structural reality of the business. So today we are putting on our financial analyst hats for a Talk Tickers edition of the Deep Dive.
Yes, strictly numbers and strategy.
Exactly. And we are focusing entirely on Ulta Beauty. Ticker symbol ULTA. Specifically, we're breaking down their first quarter fiscal 2026 results.
Right.
So we have parsed the entire transcript of the call featuring their CEO, Keisha Seelman, and CFO, Crystal Orphis, to basically translate all that Wall Street jargon into actionable insights for the retail investor. For you.
Because at the end of the day, we only care about the actual numbers and the consumer behavior that's driving those numbers.
Right.
And ultimately, we want to tell you whether you should view this as a bullish or bearish signal for your portfolio. So let's just start with the loudest number in the room, right? Top line growth.
Total revenue.
Total revenue. Just the sheer volume of cash flowing through Ulta's cash registers and their digital checkout carts. Because we are operating in a retail environment where we constantly hear about consumers being squeezed, right?
Inflation, interest rates, all of it.
Exactly. They're squeezed by inflation. They're exhausted by high interest rates, pulling back on discretionary spending. And yet, in the middle of all that, Ulta delivered a massive beat. Net sales increased 11.1% to $3.2 billion for the quarter.
Yeah, and just to put that into perspective for a second, they went from $2.8 billion in the same quarter last year up to $3.2 billion this year.
That's a huge jump.
It is an extra $400 million generated in a single 3-month period. Defying gravity is really the only way to describe an 11% top-line growth rate in the current macro climate.
Seriously.
Because other major retailers, they're issuing profit warnings, right? They're talking about the quote-unquote cautious consumer. But Ulta is out here expanding at a double-digit clip.
But, and this is a big but as financial analysts, we can never, ever take total revenue at face value.
No, never.
Because total revenue can be an illusion. I always look at total revenue as kind of a cheat code in retail.
How so?
Well, if a business has 100 stores, right, and they just go out and build 20 brand new ones, their total sales are mathematically guaranteed to go up.
Right, because of the new footprint.
Exactly. But that doesn't actually tell you if the core business is healthy. Or if the original 100 stores are quietly losing customers while the new ones prop up the numbers.
Yeah, it's the classic retail trap. You can mask a dying brand for years by just aggressively opening new doors, at least until the debt catches up with you.
Yep.
Which is exactly why the holy grail metric for retail investors is comparable sales, or often just called comps or same-store sales.
Right, the comps.
Because this metric strips out any location that hasn't been open for at least 12 months. It gives you the pure, unadulterated baseline health of the existing footprint.
And Ulta's comp store sales growth came in at 5.3%.
Which is fantastic.
It's robust, but the composition of that 5.3% is what really caught my eye in the transcript.
Yeah, the breakdown is fascinating.
Right. They broke it down into two engines, a 3.7% increase in average ticket and a 1.6% increase in transactions.
So important to distinguish those.
Yeah. So translating that for the listener, The average ticket going up means that when you walk into an Ulta or you open their app, you are spending nearly 4% more than you did last year.
You're putting more in the basket.
Exactly. You are either buying more items per visit or you are voluntarily opting for more expensive premium items.
And then on the other side, you have that 1.6% increase in transactions, which means the actual physical foot traffic, the number of distinct purchases being made, is also growing.
Right.
And that dual engine growth, that is exceptionally rare right now. I mean, most retailers showing any comp growth today are doing it entirely through inflation-driven price hikes.
Just charging more for the exact same stuff.
Exactly. They're charging fewer people more money. But Ulta is bringing more people through the door. And those people are, like you said, voluntarily spending more money once they get inside.
It just shows incredible brand gravity.
Yeah.
People aren't just tolerating the higher prices, they are actively seeking out the store, which naturally brings us to the bottom line, right? The profit.
Because making $3.2 billion is great, but keeping it is the hard part.
Exactly. Another story entirely. So Ulta reported earnings per share, or EPS, of $7.74.
Yeah.
That is a 15.5% year-over-year growth in profit.
And the math there tells a vital story about their operational leverage. I mean, if profit is growing at 15.5%, but revenue is only growing at 11.1%.
Right, the gap between those two.
Yeah, it means the company is becoming significantly more efficient. They are extracting more profit out of every single dollar that comes through the door.
Which brings us to a metric that management was clearly, very eager to highlight on the call: gross margin.
Oh, they love talking about this.
Their gross margin increased by 100 basis points to 40.1% of sales.
Yep.
Now, let me just pause and demystify the Wall Street jargon for a second, because basis points sounds incredibly technical.
It does sound intimidating.
But 100 basis points simply equals a 1% increase. So their gross profit margin went from 39.1% to 40.1%.
Right.
And on the surface, 1% sounds like a rounding error. But on $3.2 billion in sales, that single percentage point equates to an extra $32 million in pure gross profit.
Pure profit.
But my question for you, though, is how?
Yeah.
Because every single supply chain report we read right now points to higher diesel costs, higher freight costs, massive wage inflation. So how did Ulta miraculously squeeze an extra $32 million in margin out of a heavily inflationary environment?
Well, the answer lies in how they tackled one of the absolute most toxic words in the retail industry today.
Shrink.
Shrink.
The very polite corporate euphemism for theft. Organized retail crime, lost inventory, damaged goods.
Mostly theft. Let's be real. Primarily, we are talking about theft.
Right.
Shrink is that agonizing gap between the inventory a company has recorded on its financial books and the physical inventory that's actually sitting on the shelves.
And it has been brutal lately.
Oh, over the past 24 months, organized retail crime rings and just casual shoplifting have absolutely devastated the profit margins of major big box retailers and pharmacy chains.
Totally.
But on the call, CFO Crystal Orifis explicitly credited this 100 basis point margin expansion to lower inventory shrink and better merchandise margins.
Yeah.
They essentially stopped the bleeding.
But the how is what really fascinates me here.
How they did it.
Yeah, because if you walk into a typical chain pharmacy right now, like a CVS or Walgreens, it feels like a maximum security prison for toothpaste.
It's terrible.
Everything is locked behind thick plexiglass. You literally have to press a button and wait 10 minutes for an employee with a key just to buy a stick of deodorant.
And that completely destroys the impulse buying psychology that retail relies on.
Exactly. And Ulta is fundamentally a tactile, experiential playground. You go there to swatch the foundation on your wrist or spray the perfume, feel the texture of the moisturizer. If they put their whole store in a glass cage, they would kill the golden goose.
Completely ruin the business model.
So how did they lower shrink without ruining that customer experience?
So management pointed to a strategy heavily reliant on applied data and surgical precision, rather than those blanket brute force policies like locking up the whole store.
Okay.
They didn't treat a location in, say, suburban Ohio the exact same way they treated a location in downtown San Francisco.
That makes sense.
Right, they utilize deep data analytics to map out the exact vulnerabilities. And this likely involved heat mapping store traffic, using RFID tracking to see exactly which SKUs were disappearing and from which specific aisles.
Oh, wow.
Yeah, and analyzing the correlation between staffing levels and theft incidents at very specific times of day.
So instead of punishing every single customer with plexiglass, they use the data to adapt their actual floor operations.
Exactly. They took deliberate actions in high-risk locations only. So they upgraded associate training, and this is key, not necessarily to confront shoplifters, which is a massive liability nightmare.
Right, you don't want employees getting hurt.
Exactly. Instead, they train them to engage in what you might call aggressive hospitality.
Aggressive hospitality, I like that.
Because the data shows that simply having an employee proactively approach a customer in a high-theft aisle like, hey, can I help you find a shade? That significantly deters casual shrink.
Just being visible.
Exactly. They also optimize store layouts, perhaps moving the high-theft prestige fragrances closer to the checkout wrap where employee visibility is the highest.
Sure.
And the result of this data-driven posturing was a reduction in shrink across every single product category and every single geographic region this quarter.
That is just a masterclass in operational discipline. I mean, they used big data to literally outsmart shoplifters. And the efficiency unlock from that single initiative allowed them to completely absorb the higher transportation and fuel costs that are drowning their competitors right now.
It really highlights how strong the underlying management team is.
It does. The baseline health of this company looks rock solid. But, you know, these broad numbers only tell us that the business is growing.
Right, to the macro view.
To understand why the consumer is choosing Ulta, we have to look at what they are actually putting in their physical baskets. Because the beauty consumer is shifting their habits pretty dramatically right now.
Completely. The transcript reveals a very clear MVP for the quarter, and it is a category that is experiencing a massive cultural renaissance right now.
Fragrance.
Fragrance. Management reported that fragrance delivered high-teen comparable growth.
High teens.
Which is an explosive figure for what is traditionally considered a very mature, slow-growing category. Fragrance is actually ballooned to represent 12% of Ulta's total revenue.
High teen growth in perfume is just wild to me.
It really is.
Because it used to be that a consumer found their one signature scent, you know, maybe a Chanel or Dior, and they wore it every single day for half a decade until the glass bottle was entirely empty.
Right, and then they just go buy the exact same bottle again.
Exactly, it was a replacement cycle. But the culture, which is heavily driven by social media right now, has completely shifted. People aren't really buying signature scents anymore.
No, they are building fragrance wardrobes.
Fragrance wardrobes, I love that term.
Yeah, it's the perfect way to articulate this behavioral shift. Consumers now want a specific scent for the office, a different one for date night, maybe a lighter one for the gym, and a moody one for winter.
Right.
And Ulta is actively capitalizing on this by stating a very aggressive goal. They intend to become the undisputed #1 destination for fragrance in the country.
That's a bold claim.
It is. And to achieve this, they are leaning heavily into luxury houses. They're launching expanded sections for Yves Saint Laurent, Carolina Herrera, Valentino, and they even secured the early launch of the new Balmain fragrance line.
And what's brilliant is that they aren't just relying on the old guard of European luxury houses either. The transcript specifically highlighted a fascinating case study with an exclusive, vegan, cruelty-free brand called Noise.
Yes, the Noise launch.
Yeah, that illustrates how Ulta kind of acts as a kingmaker for emerging brands. They didn't just put Noise on a shelf and hope it sold.
No, they got heavily involved.
They collaborated with the brand on a comprehensive 360 go-to-market strategy. They introduced a totally new product format called Milk Day Perfumes.
Milk Day Perfumes.
Yeah, and it's marketed as a hybrid part traditional fragrance, part hydrating skincare. But most importantly, it is specifically formulated to be layered with other scents.
Which feeds directly back into that fragrance wardrobing trend we just talked about.
Exactly. You buy one Milk to perfume, and suddenly you need 2 other scents to layer it with. It's an ecosystem play inside a single product category.
It's brilliant marketing.
And the strategy worked flawlessly. This hyper-niche subcategory catapulted the Noise brand into Ulta's top 20 list for the entire fragrance division in just one single quarter.
That's incredible velocity for a new brand.
It really is. So aside from fragrance, where else did they see robust consumer demand?
So hair care was the other major pillar. That delivered high single-digit comp growth. But the nuance within this category is critical for investors to understand.
What do you mean?
Well, the growth wasn't coming from standard, everyday drugstore shampoo. It was driven almost entirely by the prestige hair care segment. Brands like Amika and Moroccan Oil. We are seeing a massive trend that analysts are calling the skinification of hair. Yeah, consumers are basically treating their scalps and their hair follicles with the exact same multi-step, high-investment regimens that they previously only reserved for facial skincare. So serums, repair masks, and scalp scrubs. Those severely outperformed the broader market.
That's so interesting. But I did notice a massive discrepancy in the hair category when reading the transcript.
The tools.
Yes. Consumers are paying top dollar for these prestige Moroccan oil treatments, right? But management admitted that sales for hair tools, the blow dryers, the curling wands, fell off a cliff.
Yeah, they really struggled there.
Even with innovative viral brands like Shark and T3 on the shelves, that specific subcategory was a major drag. Why the sudden disconnect?
It's a classic durable goods hangover.
Oh, like what happened with Peloton?
Exactly like that. During the tail end of the pandemic and through 2024 and 2025, there was this unprecedented wave of innovation in hair tools. We saw the launch of those multi-styler wands and high-tech air wrap devices everywhere on social media.
Right. Everyone had to have one.
And consumers rushed out and spent $300, $400, even $500 on these devices. But a premium blow dryer is a durable good. You don't buy a new one every quarter.
You buy it once every 5 years.
Right. So the market is now fully saturated. The consumer is fully stocked with the hardware, so to speak. So now they are spending their money on the software, the serums and masks that go into the hair.
The hardware and the software. That makes total sense. Hardware saturation. But let's look at the other side of the ledger. We know fragrance and prestige hair are booming. What are the actual laggards dragging down the portfolio right now?
So makeup and skincare, along with wellness, were the undeniable laggards. They'd only delivered low single-digit comps.
Okay.
And when you dissect the makeup category, the divide between consumer demographics becomes incredibly stark.
Oh, sir.
Well, prestige makeup, the higher-end brands like Rare Beauty and FC saw moderate growth.
Right.
But mass makeup, the more affordable drugstore-level brands like Maybelline or CoverGirl, that was virtually flat.
Wow. A flat growth rate in mass makeup is a massive economic indicator.
It really is.
It points directly to a bifurcated consumer market, what economists often call a K-shaped economy.
Right, where the top goes up and the bottom goes down.
Exactly. The lower income consumer, which is the primary demographic that relies on mass makeup, they are feeling the harsh reality of inflation at the grocery store and the gas pump. They are pulling back on everything. Even small luxuries, like a $10 lipstick.
Yeah.
Meanwhile, the higher income consumer is financially insulated enough to still shell out $150 for Carolina Herrera perfume and, prestige scalp scrubs.
That K-shaped bifurcation is exactly what Ulta's portfolio is absorbing right now. I mean, they are large enough to feel the pain of the mass consumer, but premium enough to ride the wave of the prestige consumer.
Which is a pretty unique position to be in.
It is. And this demographic divide also bleeds into another fascinating structural difference in their earnings. The performance of their physical stores versus their digital channels.
Yeah, the discrepancy there was really stark. E-commerce was an absolute powerhouse this quarter. They put up mid-teen sales growth.
Massive numbers.
Meanwhile, the physical comp stores only held steady with low single-digit growth. And we kind of skipped over this one crucial piece of the physical store puzzle earlier. I want to bring it in now.
The services.
Yes. The outline of their business includes services. The in-store salons, the brow bars, the makeup application chairs. How did those perform?
So services saw mid-single-digit comp growth. And while it might not sound as explosive as the mid-teen digital growth, the services business is the ultimate defensive moat for Ulta's physical footprint.
Because you can't get it online.
Exactly. You cannot get a haircut or your eyebrows waxed over the internet. When a customer books a salon appointment, they are absolutely guaranteed to walk through the front doors.
And they have to walk past the fragrance wall and the prestige hair care end caps and the impulse buy checkout bins just to get to that salon chair.
It is an incredibly sticky customer acquisition tool.
It really is. But returning to that mid-teen digital growth, I mean, that is a massive number for a legacy brick and mortar retailer. They highlighted their expanding fulfillment options, right? Like same-day delivery, integrations with Uber Eats, buy now, pay later financing through Klarna.
Yeah, they're pulling all the modern e-commerce levers.
But the real linchpin of their digital success seems to be BOOPS. Buy online, pick up in store.
BOOPI is amazing for margins. It is the perfect bridge between digital convenience and physical immediacy. It allows the consumer to lock in the transaction from their couch, but it saves Ulta the margin-crushing cost of last-mile shipping.
No FedEx fees.
Exactly. But beyond the fulfillment mechanics, management detailed two massive, distinct strategic initiatives that are acting as the primary growth drivers for this overall digital success.
Right.
The first is a major acquisition, and the second is a highly aggressive foray into social commerce.
Okay, let's unpack the acquisition first. They bought Space NK.
Yeah, Space NK. It's a highly curated, premium beauty retailer that operates primarily in the United Kingdom and Ireland.
So an international play.
Right. By acquiring them, Ulta is immediately padding their top-line statistics. This is what Wall Street calls inorganic growth.
Because they bought it, they didn't build it.
Exactly. Instead of taking 5 years to slowly build new stores in a foreign country, sign leases, figure out the local supply chain, which would be organic growth, they simply bought a company that already figured it out.
It makes a lot of sense.
It gives Ulta a turnkey entry into the international market with a beloved premium brand and an established wealthy customer base. It diversifies their revenue streams away from being entirely dependent on the U.S. economy.
Space NK is a classic, logical retail expansion. I totally get it. But here is where the transcript gets incredibly interesting to me and where I frankly want to push back on management's narrative a bit.
Okay, let's hear it.
The second massive growth driver they touted was the launch of their TikTok shop.
Oh, yeah, this is a hot topic.
They hosted their first ever shoppable live stream on TikTok. They bragged about getting over 5 million impressions and generated what they vaguely called strong gross merchandise value.
Right.
But I have to ask the skeptical investor question here. Isn't selling beauty bundles on TikTok just a flashy margin dilutive gimmick?
Margin dilutive.
Yeah, like if I buy my Amica shampoo directly through the TikTok app, I am inherently not buying it on Ulta.com. Doesn't this just cannibalize their own website sales while simultaneously forcing them to hand over a percentage of the transaction fee to a social media app? Why introduce a middleman?
That is a highly critical perspective, and honestly, you are not the only one asking it.
Really?
Yeah. Several analysts brought up this exact concern regarding cannibalization during the Q&A portion of the earnings call. Management was heavily prepared for the critique.
I bet they were.
And their strategic logic completely refutes the idea that they are just giving away margin to TikTok.
Sure.
To understand why it's not cannibalization, you have to look closely at the specific mechanics of what they are selling on the platform and who they are targeting.
Okay, well, walk me through the mechanics. Because paying a social network a cut of a sale I could have gotten directly just seems like bad business.
First off, they are not simply uploading their entire 25,000 product catalog to TikTok.
Okay.
They launched the shop with a highly restricted, curated assortment. Specifically, 17 exclusive brands and 30 unique product bundles.
Oh, bundles.
Yeah, these are configurations you cannot buy anywhere else. They are leveraging exclusivity to force the transaction there. But the far more important element is the target demographic.
Who are they going after?
CEO Keisha Sealman was very direct on this point.
Oh.
The primary goal of the TikTok shop is absolutely not to shift existing e-commerce revenue from older millennials or Gen X shoppers. It is fundamentally a customer acquisition tool aimed squarely at Gen Z and Gen Alpha.
Ah, so they view the transaction fee they pay to TikTok not as a loss of margin, but as a marketing expense.
Exactly.
A customer acquisition cost.
Precisely. It functions as a self-liquidating marketing campaign. They are meeting the youngest consumers exactly where their attention already lives. Endless scrolling on TikTok.
Right.
The strategy is to use these exclusive bundles to convert a new, young user who might never naturally browse Ulta.com on their own. But here's the genius part.
I'm listening.
Once that initial transaction happens on TikTok, that user is immediately funneled into Ulta's massive loyalty program, Ulta Beauty Rewards.
And that program is huge.
It currently boasts 47 million active members.
47 million members. I mean, the sheer volume of first-party data they're sitting on is just staggering. That is almost 1 in every 7 people in the United States.
And that proprietary data mode is the ultimate prize here, because once that Gen Z consumer is locked into the loyalty ecosystem, Ulta deploys their AI-driven personalization tools.
Okay, so they start tracking them.
Exactly. They can track the exact purchasing cycle of that customer. They can predict, down to the week, when that teenager is going to run out of the moisturizer they bought on TikTok.
No way.
Yes. And right before it runs out, Ulta hits them with a targeted email or an app push notification offering a 10% discount if they rebuy it directly through Ulta.com or in a physical store.
Oh, wow. I see the play now. The TikTok shop is simply the top of a highly sophisticated funnel.
You got it.
They pay the toll to TikTok once to acquire the user, but then they own the direct communication channel for the rest of that customer's life.
They never have to pay a middleman for that specific user again.
That completely refutes my cannibalization theory. I mean, it is a Trojan horse designed to capture the next generation of shoppers before they build loyalty with competitors like Sephora.
It is a brilliantly executed long-term strategy. And understanding that long-term thinking provides the perfect transition into analyzing management's guidance.
Right, the forward-looking stuff.
Because in the stock market, previous quarter numbers are just validation. Investors don't buy a stock for what the company accomplished yesterday.
They buy it for tomorrow.
They buy the stock based on the cash flows the company promises to generate tomorrow. And this is where the corporate contouring usually gets applied the thickest.
We've got our makeup wipe ready. What is the executive guidance for the remainder of fiscal 2026?
We have to split the guidance into two distinct halves. Top-line revenue expectations and bottom-line profit expectations, because they are telling two very different stories.
Okay, let's start with revenue.
Starting with the top line, management maintained their full-year net sales growth expectation at a range of 6% to 7%. They also held their comparable sales growth target steady at 2.5% to 3.5%. Maintained. So despite blowing past expectations in Q1 with an 11.1% revenue growth, they are not raising their sales forecast for the rest of the year. No, they are not.
They are basically signaling that the hypergrowth we just saw was an anomaly, and things are going to cool down to a steady mid-single-digit pace.
That is the conservative narrative they are projecting on the revenue side. But the fascinating contradiction is what they did with their profit outlook.
Did they raise it?
Despite keeping their total revenue expectations flat, management actually raised the lower end of their operating profit growth to a range of 6.5% to 9%.
Wow.
Furthermore, they bumped their full-year earnings per share guidance to a highly lucrative range of $28.36 to $28.80 per share.
Okay, let me use an analogy to frame why this feels suspicious to a retail investor.
Let's hear the analogy.
The executives are essentially standing on stage and telling us, hey everyone, the total size of the pizza, our overall sales, isn't getting any bigger than we originally told you it would.
Right.
But don't worry, we are somehow going to slice you a much bigger piece of profit.
It sounds a bit like magic.
It does. My immediate cynical reaction is to question the mechanics. Are they genuinely operating the core business that much more efficiently, or are they just financially engineering this EPS raise using stock buybacks to hide stagnant growth?
It is the most critical question an analyst can ask when guidance looks disjointed like this. The truth, in this specific case, is a powerful combination of both.
Really?
Both. Yeah. There is massive financial engineering happening, but it is entirely supported by genuine, underlying operational efficiency. Let's tackle the financial engineering aspect first, because your instincts about stock buybacks are spot on.
The share repurchase program.
Yes. Management has authorized what can only be described as a capital return bazooka.
A bazooka. I love that.
They announced a massive increase in their fiscal 2026 share repurchase target, bumping it from $1 billion up to an aggressive $1.5 billion.
That is a huge amount of capital.
And they aren't just making promises either. They are executing.
Yeah.
In Q1 alone, they already deployed $555 million in cold, hard cash to buy back their own stock on the open market.
Okay, for you, the listener, who might not be intimately familiar with the exact mechanics of a stock buyback, let's break down exactly how this manipulates the earnings per share metric.
It's important math to know.
When a company uses its excess cash to buy back its own stock, it retires those shares. It effectively removes them from existence.
Yep.
This shrinks the total number of outstanding shares available in the market. So even if the company's net income, the actual dollars of profit they make, stays exactly the same from one year to the next, that profit is now being divided among a much smaller pool of shares.
Right.
Mathematically, the earnings per share, the EPS, is forced to go up. It makes the stock look significantly more profitable on a per share basis, which usually drives the stock price higher.
It is a textbook method for returning immense value to shareholders, assuming, of course, that the company generates enough free cash flow to actually afford it.
Which Ulta does.
Exactly. Free cash flow is the actual cash a company has left over after paying all its operational bills and maintaining its existing physical assets. Ulta generates a torrential amount of free cash flow.
But to directly address my cynicism, is this just a financial trick to boost EPS?
Right. And to answer that, we must look at the other specific metric they raised, operating profit.
Right. Operating profit is the pure measure of the business.
It is.
It calculates the money made from actually selling cosmetics, minus the cost of the goods and the daily expenses of running the stores, long before taxes, interest, or share count manipulation ever enter the equation.
And the fact that management raised their operating profit growth expectations is the ultimate proof that the core business is genuinely running leaner and meaner.
Okay, so it's not just a trick.
No, they are not merely relying on a shrinking share count to paint a pretty picture. They are actively extracting more profit out of every single dollar of revenue. And this circles back perfectly to the data points we analyzed earlier.
The shrink reduction.
Yes. The surgical reduction in shrink, the supply chain optimization that absorbed those freight costs, and incredibly disciplined control over their SG&A.
Let's define SG&A real quick for clarity.
Go for it.
Selling, general, and administrative expenses. This is everything from the rent they pay for the physical store, the corporate salaries in Chicago, the marketing budget, all the way down to the hourly wage of the associate helping you color match a foundation.
Exactly.
They are keeping those costs strictly contained while revenue goes up. So the narrative comes together perfectly. They're firing on both cylinders.
Yep.
The business operations are hyper efficient, generating massive piles of cash. And they are turning around and using that cash to buy back stock, rewarding the shareholders who stick with them. I mean, it sounds like a flawless, bulletproof setup.
It is an incredibly formidable setup. But we cannot ignore the bronzer they tried to apply during the forward-looking statements.
Oh, there's always a catch.
CFO Chris DeLorifus issued one crucial caveat regarding margins. And retail investors need to pay close attention to this nuance so they aren't surprised in 6 months.
I knew there had to be a blemish somewhere. What is the warning?
It's a margin warning for the second half of the year. Management made it explicitly clear that the gross margin benefits we celebrated in Q1, specifically those massive data-driven wins against shrink, were heavily front-loaded.
Front-loaded, okay.
They rushed to implement those operational changes early in the year to secure a quick financial win. But as we move into Q3 and Q4, they will be comparing their performance against periods in the previous year where those shrink improvements were already active.
The brutal reality of year-over-year comparables.
Exactly.
You can only fix a break in pipe once. Once it's fixed, you don't get credit for fixing it again the next year. Your growth suddenly flatlines.
The math is inescapable. Because they are guiding for gross margins to be roughly flat for the entire full year, and Q1 was up by 100 basis points, the back half of the year is mathematically guaranteed to see tighter and potentially even slightly negative gross margin comparisons.
So an investor reading the headlines in November might suddenly see Ulta reporting shrinking gross margins and just panic, assuming the business is failing.
Exactly. Which is why understanding the mechanics right now is so important. However, management also noted a counterbalance to this.
What's the counterbalance?
While gross margins will tighten in the second half of the year, their SG&A expenses are projected to step down simultaneously.
Okay, how so?
Well, in the first half of the year, they absorbed heavy one-time expenses, things related to integrating the Space NK acquisition and funding massive new marketing initiatives.
Like the TikTok shop launch.
Right. But in the second half, those expenses fall off the books.
So there's a giant financial balancing act. Gross margins get squeezed a little bit, but the operating expenses drop, so the overall operating profit remains steady.
You hit the nail on the head. The destination is the same, but the vehicle they use to get there changes completely from Q1 to Q3.
This is precisely why you have to read the full transcript and not just the press release bullet points. You have to know the composition of the profit to actually trust the guidance.
100%.
All right, we have scrubbed the top-line revenue, we've analyzed the shifting psychology of the beauty consumer, and we've demystified the financial engineering of the forward guidance. It is time for the bottom line.
The verdict.
We promised an actionable, opinionated stance, so I am going to plant my flag right here based on everything we've unpacked today.
Let's hear it.
For you, the retail investor who currently holds this stock or is perhaps looking for an entry point during a market dip, this quarter represents a definitive, undeniable bullish signal.
Bullish. Okay.
Let's just look at the harsh reality of the broader retail landscape. We are operating in a noisy, unforgiving macroeconomic environment. Credit card debt is at historic highs. Interest rates are suppressing housing moves. The consumer is highly value sensitive. And yet, in the face of all those headwinds, Ulta is actively expanding its market share in the prestige beauty category. Their foot traffic is accelerating. Their average basket size is growing.
The numbers don't lie.
They have proven they possess genuine pricing power because consumers view prestige beauty, whether it's building a fragrance wardrobe or investing in a Moroccan oil scalp treatment, not as a frivolous discretionary luxury, but as an essential, non-negotiable part of their daily routine and self-identity.
I wholly agree with that assessment. It is the ultimate test of brand resilience, and Ulta is passing it while their competitors in the mass market are stumbling.
Right. And taking that a step further, beyond just consumer resilience, you have an executive management team that is executing a masterclass in operational discipline.
Yeah, we've seen that throughout the transcript.
They didn't just complain about retail crime like their peers. They used proprietary data to surgically neutralize the shrink problem without degrading the shopping experience.
That was huge.
They optimized their supply chain to absorb inflation. And most importantly, for anyone holding the ticker, they are taking the immense free cash flow generated by this efficient machine and handing it directly back to you via a $1.5 billion stock buyback bazooka.
The bazooka is a game changer.
When a management team authorizes a buyback of that magnitude, they are aggressively declaring that they believe their own stock is fundamentally undervalued by the broader market. I am bullish on Ulta because it offers an exceptionally rare combination of cultural relevance, consumer stickiness, and ruthless financial efficiency.
The underlying data supports that thesis entirely. They're operating as a best-in-class retailer in a highly defensive, emotionally driven consumer category.
But before we wrap up this deep dive, I want to leave you, the listener, with one final provocative thought.
Oh, lay it on us.
A concept to mull over on your own that goes beyond the quarterly spreadsheets we just dissected. Hidden deep within the prepared remarks, CEO Keisha Sealman casually dropped a massive piece of strategic news near the end of her script.
You were referring to the Times Square announcement.
Yes. Management revealed that in late 2027, Ulta is slated to open a massive, highly experiential flagship location directly in Times Square, New York.
A huge move.
But the way she described it was telling. This isn't just going to be a large store with more lipstick aisles. She described it as a dynamic destination featuring multi-story digital billboards, immersive brand activations, and next-level storytelling.
Right.
Now, take a step back and connect the dots. Couple that Times Square digital playground with their deep, exclusive integration into TikTok live streams, which we discussed as a top-of-funnel acquisition tool.
Yep.
Then layer on top of that their rapidly expanding UB Media Network. This is their retail media ad network, where massive conglomerates like Estee Lauder and Clinique actually pay Ulta for enhanced data measurement and premium advertising space across Ulta's digital channels.
When you synthesize those three distinct initiatives, Times Square, TikTok, and the retail ad network, a fundamentally different corporate identity begins to emerge.
Exactly. So here is the question I challenge you to ask yourself. Is Ulta Beauty quietly evolving from a traditional brick-and-mortar retailer into a high-margin digital media and discovery platform that just happens to sell lipstick?
That is a massive paradigm shift.
Think about the implications. If they are successfully transitioning from a company that simply buys a bottle of perfume for $10 and sells it for $20 into a company that monetizes the eyeballs of 37 million highly engaged, data-rich consumers by selling ad space, digital billboard impressions, and social media integration back to the beauty brands themselves, that is a totally different business model.
Software and advertising carry vastly higher profit margins than physical retail.
Exactly. I challenge you to completely rethink how you value this stock going forward. Because if management pulls off that transition, evaluating them purely as a retailer might mean the current valuation is an absolute steal.
It is a phenomenal reframing of their long-term trajectory, from an omnichannel merchant to a full-stack media platform.
We started this conversation talking about makeup contouring, how executives highlight the good and shadow the bad.
Yeah.
But when you finally use the makeup wipe and look at the barefaced data of Ulta Beauty, what you see isn't just a healthy retailer surviving a tough economy. You see a company actively contouring its own future, evolving its very identity and business model right in front of our eyes.
Well said.
Thanks for joining us on this Talk Tickers deep dive into Ulta. Keep those analyst hats nearby, and we'll see you next time.